All right, welcome back, everyone. So I apologize for the delay. I actually had my second COVID shot earlier. Well, it was probably 3 days ago, and immediately just got achy, felt sick. So I was planning on recording this about 3 days ago, and I had to take my second COVID shot. So anyway, we're back. If I have pauses, I'm gonna try to edit everything out, obviously, but I might have pauses and things like that. I have a lingering cough. So either way, we'll make it work. And today we have a huge topic. I mean, it's going to be massive. We are talking about beating the market. This is, again, from the intro, the holy grail. I mean, people are always talking about what stock they crushed it on, or, which crypto they made 10 grand on, or something like that. And so I just want to talk about that. And today is going to be part one, and I'm going to talk about three of the most important factors to even get yourself in a position to beat the market. And obviously, there's more than three, but in my opinion, these are three of some of the most important, again, to even get a seat at the table to beat the market. And when I say the market, we're talking S&P 500. Uh, I'm thinking for part two, I'll talk about specific vehicles. So, example, individual stocks. Some people might use options to try to beat the market, etc. Um, I guess also, I'm just gonna leave it there. So, if we're talking about that, we're gonna just talk factors. So, again, the most important top three to even get a seat at the table to put yourself in position to beat the market. So, the first one, you have to have correct expectations. So when we talk expectations, what does that even mean? Like, what's reasonable? What's good enough? And that's a personal decision. Um, if we're going to simply just try to beat the S&P 500 on an annual basis, what does that mean? Is 1 or 2 percentage points higher good enough? Is 5% higher good enough? Right? If the average over the past, 100 years is somewhere between 8 and 10%, what would it even take to get 12, 15? Is that even unreasonable? You know, um, and then the other way to take it, it would be like tactical changes. So people, investment managers or money managers might say, oh, well, over the next quarter, we think that international might outperform. So we're going to tilt your portfolio to international to really try to get a leg up. Does that even work? I don't know. So it's really tough. And then also thinking about what is the risk involved. So here's an example, to talk about expectations and whether or not they're unreasonable. A friend of mine said someone that goes to their gym had a multiple six-figure growth in their portfolio since the pandemic started. And they're like, oh, yeah, I'll just quit my job and I'll earn 30% a year. So I immediately said, okay, you need to tell that person not to do that because it's just not realistic. Again, going back to reasonable expectations, and I don't know what those would be. Again, this is just to put yourself in position to sit at the table. And again, part of that is having those reasonable expectations. And honestly, it comes back to, why do you even want to do it in the first place? Is it to tell your friends about it? Is it because you're late to the game as far as saving and investing goes, and it's all you can hope for is that you might get lucky and beat the market consistently over the next 10 years? I mean, which you don't have statistics on your side, but again, we're assuming it can be done. And this is just thinking about how to get a seat at the table to do so. Maybe you want to do it because it's a fun challenge. I have a client that just said, yeah, if the market earns 10%, I want to at least earn that. And if we can earn a little bit more, great. I'm totally fine with the volatility, which I'll talk about. That's my third point of, the most important things. But, and he's just like, yeah, I understand that it comes with risk and I might be down a lot where the market might be flat. So it just, again, setting that expectation of what you think is realistic. Again, it's tough to put parameters on it, but if you said, yeah, the market returns, again, that 8 to 10% on average, right? That's with years where it might be minus 30 and the years where it might be plus 60, right? And again, it just averages out to that somewhere between 8 and 10%. Well, okay, you could probably think about, if you want 20, that might be a little bit unreasonable year over year. You can Google, Jim Simons, the Renaissance hedge fund guy. He's, to my knowledge, the only person that's beat it consistently and beat it and absolutely crushed it. So if you want to Google that, that's fine. His returns were absolutely ridiculous. I think somewhere in the neighborhood of between 35 and 45% after fees. So again, just in summary of this first point is just setting the table for expectations, right? If you want to beat the market by a few percentage points, okay, maybe you can put yourself in position to do that. If you're trying to double the market's growth every single year as just a retail investor, that's going to be very tough to do. Moving on, second point here is behavior. So this is it's an intangible value add in my business to clients. And if you think about it, investor behavior is actually the biggest factor in determining return. Excuse me. However, it's not the sexy thing. You can't quantify this to clients and say, well, if you just practice smart investor behavior, which I'll talk about what that even means in a second, then your returns will be higher. You have to actually see the results first, and then you can go back and be like, oh, I told you so. But if you do that, you look like a jackass. So it's just, it's a lose-lose. However, it's the most important factor in determining return. And so what do I mean by that? You're literally fighting your brain when it comes to making these investment decisions. And the example that I think of right now is Zoom. I mean, the stock ticker ZM, Zoom. If you look back to a year ago, doesn't it feel like you, quote unquote, just knew that that stock would explode once the world got shut down? Like, didn't you just know? I mean, it feels like it, doesn't it? So if you knew, why wouldn't you just put your entire life savings into it? It sounds so simple now, but the answer is because how you feel now is totally different than how you felt then. This is the classic hindsight's 2020. And so it's really tough. And now seeing, I took on clients last year that were like, yeah, we actually the best example, right? I have a client that came on in February of last year. So when the market was, right before the month before it took the huge dip. And they had told me that back in '08 they moved all their money to, whoever. And after it went down, they moved it all to cash and they got scared. And that was, 12 years ago, 13 years ago, whatever. And 15 years, I don't know. Anyway, so they moved all their money and they moved it to cash. And now they're just, they were mad. They were mad that they missed out on a huge bull market. And they're like, we never want to do this again. Well, fast forward to February of last year, 2020, and the market went down. And so immediately they moved their money. It went down, 25, whatever percent. And I remember an email and the client goes, yeah, I should have just told all my friends that whenever we move money or start investing again, it goes down. And I just laughed. But the good part about that was that I focused on behavior to set the table for them to say, okay, we know that recessions, downturns, etc., will happen. How we position ourselves through them is how much success is directly correlated with how much success you will have. So, but the problem is, again, you're fighting your brain. So if you think about a casino, right? If you went and played roulette and you're like, okay, I'm just going to pick red or black. I'm just going to try to pick some winners and we'll go from there. Well, let's say your bankroll is $500 and you are playing $100 per roll or per spin rather. So You pick red or black and you lose and it's red. And then you get three more reds in a row. And now you're like, okay, well, I'm down to my last $100 and it's been red all four times. That means what? Your brain is going to either tell you one of two things. It's going to say, oh, well, it was red four straight times, so now it has to be black. Or it was red four times, now we're on a hot streak, so it's going to continue to be red. Both of those are wrong. And your brain just makes you think one of those things or both because that's just how the brain works. And in reality, with roulette, it there, if how it works is a normal distribution, right? Back to statistics class, right? If it's a normal distribution of 10,000 spins, there's gonna be a time where you get 30 in a row of one color, or 50 in a row of one color, or alternating colors 50 straight times. It's the same as if you were to flip a coin. And so again, you're just fighting your brain. And that's the toughest thing to do in investing is buy when things are down, right? What does Warren Buffett say? Be fearful when others are greedy and greedy when others are fearful. And if you think about that sentiment last year in March, right? I remember calls on March 20th of last year and people were freaking out. And I was telling them, hey, actually we're rebalancing and we are buying more. We're buying more equities because if you think about it this way, if you went to your favorite department store and everything was 30% off, how many carts would you fill up? Probably quite a few. So it's just really tough. And that's where, clients can get pissed. I mean, there's time, or investors, right? You can feel miserable because as an advisor, I don't like to see when people's accounts are down. I mean, that doesn't make me feel good either. And so, me personally, right, the advisor, and I'm going to do a podcast on this eventually, but advisors can also have bad behavior when it comes to investing because they don't like to see other people losing money and they might move their clients to cash. And it's really tough to practice what you preach and keep the client invested and make sure that they're on the right track. So another point to this of behavior is the due diligence factor. So imagine if you want to try to beat the market, right? Imagine you went and did a ton of due diligence and research and you quote unquote just know that your chosen stock has to go up because you did so much research, you spent so much time. But what if it doesn't? That's really tough, and investing is the opposite in a lot of cases of other hobbies or topics in life, where sports is probably the best analogy, right? If you go and you're terrible at shooting free throws and you go shoot 1,000 free throws a day for an entire year, do you think you're going to get better? I would argue, yeah, you probably would. Investing doesn't work like that. You can put a ton of time, a ton of due diligence, a ton of research in and still be wrong. And there's plenty of examples. And the biggest one is probably Bill Ackman with Herbalife, where he just kept doubling down on shorting the company and it finally admitted he was wrong. But the takeaway here is that the amount of time spent doing research, due diligence, etc., does not directly correlate with the results that you might get while you're investing. And that is so tough for people to understand, that they could just be wrong, even though they put so much time in to deciding on what investments they might choose. And it's really tough. So on the other hand, though, I remember tons of conversations with friends over the past year where I'd be like, oh, we called that. We knew that was going to go up, but yet we didn't pull the trigger on a trade. And it happens nonstop on both sides. It's tough to admit you're wrong. And then on the other hand, you're like, oh my gosh, we could have made so much money if we would have just bought XYZ company. And it's just so tough. So you have to be aware enough to understand that this is going to happen and you're going to have to fight the human brain. One analogy is with golf. And I hate to keep making sports analogies for the non-sports folks out there, but like imagine you hit a golf ball and you're behind a tree, or the golf terminology is, oh, you're in jail. The smart shot might be to punch out in the fairway, try to go up and down, make a par. Well, your brain is like, no, no, no. I can hit this hero shot. I can hit this, this really, really, really difficult shot. I'll, draw it around these trees or fade it around these trees. I'll hit the green. I still can make birdie. But what actually ends up happening is that you hit the tree, then you got to punch out, then you go and make your pitch onto the green, and then you 2 or 3 putt for a double or triple bogey. So it gets really tough. And part of it, again, it just goes back to behavior. So you have to be aware of that. If you're trying to beat the market, you have to have solid behavior. You have to have rules in advance for each trade. So you have to be able to say, okay, if this goes down 20%, or if this goes down 50% or whatever, you automatically set that trade in advance. You're going to stop the loss. You're going to get out of the trade no matter what, because your brain will say, no, 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 let's buy more, right? That's actually what your brain says is let's double down. You're right back to the casino where if it's red and you lost, you're like, 4 times in a row, you might say, oh, let's reach back in my pocket. It can't be red again. Let's just put another $500 on black and get all our money back, and then we'll start fresh. Well, we know how that works out, right? That's why casinos are in business. All right. So the last one, as far as important factors, if you're trying to beat the market, is it kind of coincides with the behavior, but it's the ability to handle volatility. So again, remember what I was saying about you have to know when to get out and take your profits? Well, you also have to be able to handle the ups and downs, and it's really interesting because your brain will say, generally speaking, like with traders, they will not cut their losses early enough and they won't let their winners run long enough. And the classic one for that is, oh, if you would have bought Amazon in 1999, here's how much money you would have had. It's like, well, no one did that because yeah, it might have doubled, but then it also got cut in half multiple times, and people just can't handle that. And that's what is, again, the biggest determining factor in whether or not someone can beat the market. And not only beat the market, for 1 year, like, oh, good job, you bought some GameStop and you made 10 grand, you made 100 grand, whatever. It's like, okay, well, now do that every single month, every single quarter, every single year for the rest of your life. It's just ridiculously tough. And if it wasn't tough, everyone would just do it and everyone would be rich and money would be meaningless. So that's what's so tough. Again, back to volatility, handling up and downs, right? Can you handle a 50% decrease or more in your investment selection when the market's only down 25%? Will that piss you off? I don't know. Again, and this is what we might say, or what I might call return per unit of risk. So what does that mean, right? It means there's a trade-off between risk and return. And this is exactly why, for example, why your bank account earns nothing. It cannot go down. The balance does not go down, but it also doesn't earn anything. So on the flip side of that, this is why people invest in stocks, is because you at least give yourself the ability to make money and earn more than your bank account. But what comes with that is the potential for losses as well. And this is exactly why you cannot have an investment that has a super high return with zero risk or with low risk. Otherwise, the market just would cease to exist. It just doesn't work like that. So knowing this, right, most people, it's really tough, right? When I have conversations with clients, I'm, through thousands of client meetings, it's most people just can't handle that. I know if I took a poll across my book of business and said, hey, how many years in a row would you like to have like 2020, where your account took a 30% decrease, and, or 20%, whatever the number was, and then ended up finishing the year up 20% or up 15 or whatever the number. I mean, people just don't like that. Generally speaking, people like consistent returns. They want to control what they can control, which is saving as much as they possibly can, investing in things with low fees, diversification, et cetera, et cetera. But we're not talking about that. We're talking about how can we beat the market. And to set the stage and to set the table to do that, you have to set your expectations correctly, right? Expecting 30% per year, like in my example, is not a thing that you should be able to do and be able to expect. If you do it, kudos to you. You will be one of the best investors of all time. But yeah, you have to have the expectations and you have to have the guts to act on those as well. And that leads into the second one, which is behavior, right? You have to have the guts to do what your brain is telling you not to do. Or if your brain is telling you to do something, you do the opposite. And it's so, so tough to do. So if you have your expectations set, you are aware of your behavior and you recognize it. And this doesn't come overnight. This comes with a lot of practice. And a lot of people will say that they paid their tuition with losses, and the school of hard knocks, and as far as investing goes. So if you set your expectations, you have proper investor behavior, and you have the ability to handle some volatility, you at least put yourself in position to beat the market. And I hope that people are able to at least take something away from that, because it's not easy to do. So I'll leave it there for part one, like I mentioned. And for the second part, I'm going to talk about specifics. So I'm going to go into different vehicles that one might use and the pros and cons of doing so to beat the market. So again, I hope this was helpful. I apologize for my voice sounding, a little groggy because of this second COVID shot. Good luck with everyone's investing, and we will catch you next time. Thanks.